Today I'm joined by Javad Mostofizadeh, a partner at Wilmer Hale in San Francisco. Javad is one of the go-to fund formation lawyers in venture capital and growth equity space. He's spent over 2 decades advising some of the most well-known VC and PE funds in the country on everything from structuring and launching new funds to ongoing operations and investor relations. Before Wilmer Hale, he was a partner at Latham & Watkins and spent a decade as a partner at Gunderson Detmer. He's seen from the fund formation world from every angle. Javad, welcome to FundOps HQ. Thanks for being on with me.
Yeah, thanks for having me.
Awesome. Well, I am very quickly going to ask you for venture capital and seed and growth equity specific questions. Before we get into that, can you tell us a little bit more about what does a fund formation lawyer do? And from my perspective, sometimes I'm speaking with folks and I say almost like unjustly get labeled as fund formation because I feel like it puts them in a box of just this one thing that they do. So given that context, can you tell us a little bit more of, yes, of course, you're helping to make fund docs, but there's a lot more that goes along the way of like actually building a relationship with the client and advising with more than just, hey, this is the subscription doc your advisor is going to sign.
Right. Yeah, for sure. I think at the very outset, they're seeking you out, clients are seeking you out because they want to raise a fund, but there's a lot that goes into that from the standpoint of strategizing on, terms, reviewing their marketing materials and making sure that from a legal standpoint, everything is copacetic, drafting the investor facing documents. So those are all sort of the things you would do as part of the fund formation. And, when investors receive the documents, they may or may not make comments and send them to their lawyers and request side letter provisions, et cetera. And all of that sort of marches toward, is part of a process that marches towards closing, and there could be multiple closings. So that's the sort of the fund formation process itself. There's other vehicles associated with the fund complex, the management company, the upper tier entities, the GP, places where the carry goes, and all of that has their own sort of economic arrangement. If there's more than one person, obviously, if it's more than one GP, how do they share economics? How do they deal with governance? So there's those sorts of issues in terms of helping them, structure how they're building their firm, frankly, especially again, if there's more than one decision maker. And then there's, obviously things that they may agree with investors as part of the fund formation process. Investors may say, hey, we don't want you to do this or that, or, if you're going to invest in this kind of company, we want, or outside the US, we want to make sure you make this tax election. So there's operational things as they're deploying the capital that you need to be mindful of and that we advise on to the extent, there's, again, things that they've agreed with investors that they won't do or they'll do in a certain way. So the role gets into advising on deploying capital as well.
Yeah. So there's a lot that goes into it. And you have tax expertise as well. We'll touch on that in a little bit. One thing that you mentioned, the side letters, let's actually just dive into that. And I'm curious if either from past examples or recent conversations that you've had, what are common side letter negotiations? And typically for listeners who aren't as familiar, side letters, depending on sort of the scope and scale of a fund, will be private negotiations between one larger investors, but as funds get larger and more institutional, they can get so sort of large that they're tiered into sort of groups of tier 1s, 2, 3s, and et cetera. I'm curious from funds that you work with, what are common side letter arrangements? How are they typically structured? And this is a lot I'm throwing at you, is how do you advise emerging managers, like what's enough, what's too much, like keep it simple, don't overcomplicate it. So there's a lot there. Maybe start with just like laying the ground of like, hey, look, this is how side letters typically structured, and this is what it's meant for.
Yeah, side letters are sort of they're just a recognized sort of an accepted part of the process. Effectively, you have your governing documents, which is the LPA, but to the extent that investors may want additional comfort if the LPA says one particular thing, but it's unclear, they may want clarification in a side letter as to what it means. So there are probably different buckets of side letter provisions. There's provisions that, that certain investors, given their own regulatory or tax status, may feel that they need in order to invest in the fund. Either agreements by the fund manager that if certain types of investments are pursued, that you'll make certain tax elections or you won't do certain things. There could be investors that are, just that are subject to pretty stringent regulatory requirements, whether they're banks or whatever, that they need some comfort that their ownership isn't going to exceed a certain percentage of the fund or voting or things like that. So there's things that their own structure drives sensitivities that the general partner can agree to address those things in side letters and not muddy up the governing LPA with thousands of provisions that each investor needs. So yeah, there's sort of regulatory tax type provisions. There's provisions that the LPAs themselves are very stringent on confidentiality obligations, and investors won't share materials. But whether you have a fund-to-fund investor that may need to give certain information to their own investors, or you have an organization that just wants clarity that, hey, I know I can't share this information beyond the four walls of this organization, but I need to be able to give it to our auditors or the CEO, or just clarification as to what they can share. There are public entities that may be subject to FOIA, where they need some clarity, or that the general partner wants clarity as to what how they'll deal with a certain FOIA request. There are other things that can go in side letters that deal with economic concessions, investors, anchor investors, or other types of investors. If they're writing a really large check or they're the first closer, they might get a fee or a carry break. And that stuff tends to be codified in side letters. And then sort of the catch-all is really an MFN provision, just given the sort of proliferation of side letters. So
could you just give a super quick sort of overview what MFN is?
Given all that, I think the sort of categories I described, and there's certainly others that I didn't touch on. The side letter game in and of itself can kind of go out of hand in some ways. Like I remember I've gotten side letter requests where from certain investors, it's just their form side letter, they'll send it to you, and it's like,
It's
60
its own
to 100
set of
provisions that they're
Jesus.
requesting.
Yeah.
Yeah, and it's in that in and of itself can be an exercise that can take so much time and result in the bill being higher. So anyway, the point is that with many funds, there are a lot of side letter provisions, and an investor may feel like, well, what's in those side letters? We want to make sure that we're not getting a worse deal than someone else, especially if we're writing a significant check. And so one way to deal with that is to ask for an MFN provision. And the MFN, it stands for most favored nations. And the gist of it is essentially that if you're agreeing to, provisions with other investors, we want the benefit of them. And there's certainly things that are carved out of the MFN provision to the extent the general partner is agreeing to give them. But there's sort of rules of the road as to, if it's not carved out and you're otherwise not a defaulting investor or whatever, then you can get the benefit of other things. And so it kicks off a process after the final closing, typically, where you share the various investor side letter provisions that you've been giving to others. And to the extent a provision is given because of X, Y, or Z, then you'll get that too, assuming you also meet X, Y, and Z. You can sort of structure the side letter MFN process such that you'll get the benefit of side letter provisions of investors that have, similar or lesser commitment than you, but you're not going to get the benefit of side letter provisions that we've given to investors with a higher commitment. You don't always do that, but that's sort of size basing the MFN process. And so there's lots of ways to sort of deal with it to get investors comfortable that they're not sort of getting a worse deal than other investors. And some funds will actually, because the process can get so out of hand, take a fairly disciplined approach and say, look, we're not going to give side letter provisions other than for regulatory or things that you absolutely need because of your own regulatory status or whatever. But that's sort of an attempt to sort of rein in that process. As with many things in the fund formation, a lot of it does come down to, the market dynamics. And if you're really trying to get an investor over the line and they really want side letters or an economic concession and you're having a difficult time raising money, which is not that unusual these days, then, sometimes it can be hard to keep that process reined in.
Got it. Well, you gave a ton of great stuff there. I want to go back to a couple things, but firstly, just to the point you just made, I'm curious about timing. I mean, what you just laid out is there's so many different ways that things can go. I guess on one side of the spectrum, you mentioned there could be institutions that sort of show up with their boilerplate side letters, hey, deal with it. And then maybe a more traditional negotiation is conversations over a course of weeks or months. I'm curious, let's think of like a traditional vanilla, like good fundraise with good momentum, things are tracking, there's investor interest. Like how intensive is like a one-on-one LP negotiation for a given set of side letters? Does it drag on like weeks, months, or are you typically able to have a few turns and like be done with it?
Yeah, it's more the latter. I mean, it's not weeks or months. I mean, it can be weeks, not months. Unless there's some other thing that's driving. If all the parties are engaged and driving towards a crisp closing process, the typical timeline from when you send docs out to when you close, again, assuming all the things you just laid out, good momentum, et cetera, is about 8 weeks. And so you send the LPA out, you get ideally you ask for investor comments and side letter requests in 2 weeks from the day you sign it out. A lot of times that slips, but you're trying to create a cadence and a timing roadmap for the investors to follow. And so, yeah, I mean, if you get, one of these 40-page side letter requests, then, oftentimes you'll have a conversation with your client, say, how do we want to approach this? Do we,
Right. Like, are
yeah,
we here
let's
to
try, yeah. Do
hang
you
out
need
and
to have a
negotiate
conversation
this,
with
or do we
them,
need
or
to, like, let's get to the finish line somehow?
yeah, and sometimes they can help. It's kind of like, and a lot of times as the lawyers, you're not really necessarily privy to the business level discussions. They might have said, oh yeah, we're in, we're going to be easy. We just got to send over our form side letter, and it's like 40 pages, and then you need to calibrate with the client is how do we want to deal with this thing. So, but yeah, I mean, if you will, after having that conversation with the client, you'll come up with a side letter proposal. Oftentimes, as the fund with a set of side letter provisions, at the end of the day, you have to live with those. And so oftentimes you'll want to make sure that there's common language. So as fund counsel, if you're getting, a side letter on a particular, topic, you don't want 40 different flavors of that if you have 40 investors that you're giving that side letter provision to. So you'll typically use your own language that is substantively addresses what the request is. And so you'll sort of swap out here's our language for the thing you asked for, and then you might get some comments back. And if you've left certain things out, you'll have to have a conversation as to why, and then you'll
Yeah.
flush out as part of the negotiation what's really important and what's not. If that makes sense.
Got it. One thing I thought is interesting that I hadn't really thought of that you mentioned, which is some of the side letter negotiation that you're mentioning are pretty operational for an LP. Like, of course, or people think of like the economics of it, like, hey, I'm an anchor investor, give me special terms. But you mentioned some that are like, hey, look, we have specific reporting requirements that are on us. And so can we write in that we have access to certain data? And that's very not, I would say, like, hopefully pretty frictionless. It's more just, hey, look, we need this information. Let's write in just to make sure it's clear to all parties that like we have access to whatever we need. Happy to come into the fund. Terms are fine. We just, can't have confidential blockers in certain areas, right?
Yeah, it certainly becomes you'll get um, requests that say, hey, we're this kind of vehicle that's investing in your fund, and so we have these reporting requirements, and give us anything we might need. If that's the request, then you're a little nervous as the fund counsel or the fund manager, because you're not really sure unless you know or are educated as to what the requirements that they're subject to are. Because obviously, especially in venture, you're investing in private companies that may be very early stage. You don't want to reveal the secret sauce to the company. So you want to have, ideally you might get one of those requests, but our job is to then narrow down like what is it exactly you're looking for, you might need or have to disclose, and then let's try to make this less general, a bit more
Okay.
specific.
That's a great point.
Other approaches are a bit more like, okay, yeah, we'll give it to you, and then you might couch it that we don't have to do anything that's going to jeopardize our own fund or our other LPs or whatever. You don't want someone to, if you have a very high net worth sort of sensitive investor in your fund, and someone might need the investor doc, the identity of the other LPs or something like that. You want to make sure that you're being thoughtful as to what you're agreeing you might give them, um, and just put guardrails around what it is you have to do. You don't want to set up an obligation where you may have to breach it. So you think about all that stuff when you're crafting the side letter language.
Great. Well, we'll get off side letters after. One more point I'll just make is
Yeah.
for the points about the side letters that you mentioned that are economic, we're a fund administrator that manages that too. So to the burden of your point of on the GP understanding, hey, let's keep these all straight and try to broadly bucket them. It's a little bit the same here on the fund admin side too, where if there are 10 investors that have different management fee structures and different waterfall terms and different incentives, it's on us to track it. And we have really robust processes and tools to help us track it, but it's more complex. And so we do generally, at least for emerging managers, try to encourage them to be simple. And so to wrap up this section, I was going to ask, like, if you were to give, what are some of the pieces of advice in this universe that you would give to emerging managers, given what we discussed here?
Yeah, I mean, in a perfect world, you're not cutting different economic concessions to different investors. I mean, in some ways, you do need to disclose that you're maybe not necessarily what the specific deals are for each investor, but if you're doing that, you need to have some disclosure that you might be cutting, or that might be certain investors that have special economic arrangements. And you might take the position that it's only for people that invested in the first closing, or have commitments over a certain size. But I think once you let the cat out of the bag, it can be difficult to hold the line. And so I just have seen so many times where fund managers try to be disciplined about, okay, we're only giving concessions to these categories of people, but then it opens up conversations and they end up giving away a lot of their economics. And investors don't love that either, because they want you to be appropriately incented, to go off and make great investments and be rewarded for that in the form of the carry. So it's a balance. I do think, the complexity, if you have, 10 investors with 10 different economic arrangements, can sort of, yeah, to your point, be very unwieldy from an operations standpoint and tracking and accounting. One way of solving that is if you did have one category of investors that were sort of had the standard deal, you don't have to do this, and then another category that may have like maybe a 10% discount, or whatever it is, economic concession, you could put them in a parallel fund, and that way the economics within that fund are all the same, the economics in the main fund are all the same. You don't have to do that, but you can have the investors in one vehicle that have different economics, but it does become a difficult tracking exercise.
Yeah, no, absolutely. Well, moving on briefly, just a little bit into SEC registration, SEC obligations. Venture capital is a little bit unique because it has its own venture capital exemptions. Can you just talk a little bit at a high level for investment funds broadly, sort of what their obligations are, generally gonna have to register with the SEC, what that looks like? We can keep it high level here, and I may sort of chime in a little bit more, definitely specifically around the venture capital exemptions and the
Yeah.
like.
Yeah. So high level, once you're managing someone else's money, you're an investment advisor. And if the assets under management of a manager, and when I say manager, you're not looking at specific funds, you're looking at the investment advisor tends to think of it as the management company. That's kind of where the advisor resides. So if that
Yeah, you can't
advisor
really
is,
decouple strategies or
yeah,
decouple
right,
sort of
right.
entities. It's broad. The SEC is generally going to look at you are the same folks managing reasonably these entities. They're all going to come under one sort of umbrella.
Right, right, right. I mean, that's getting into a slightly different topic as to when the SEC might, even if you tried to set up a different manager, quote unquote, if it's the same people making the decisions or more or less, they might integrate those two. So yeah, think of the manager, for simplicity purposes. Let's say they have a few different funds they're advising. If the combined assets under management that they're advising across all the funds, is in excess of 25 million, then they're on the SEC's radar screen, meaning the federal rules kick in. Under 25 million, which is, we don't typically work with clients, but sometimes you do, that that are small or they're getting going. But under 25 million, the federal rules don't apply, and you're looking at the state rules as to the registration requirements. But assuming over 25 million, then you have to register as a registered investment advisor unless you have an exemption. And the two main exemptions, the first is if your total assets under management are below 150 million, then you have an exemption. And obviously, if you're that exemption, because it's based on or it has a cap based on the assets under management, won't scale if you're raising multiple funds that collectively will exceed that. So the other one that does scale is the venture capital exemption. And the venture capital exemption requires that every single pool of capital, SPV, fund, et cetera, that manager advises qualifies as a venture capital fund. And a venture capital fund is a fund that pursues a venture capital strategy and that doesn't invest more than 20% of its capital commitments in non-qualifying investments. We'll get back to that in a second. It doesn't incur leverage generally that's other than really short term. And that doesn't exceed 15% of total commitments. So there's some other requirements, but the main one that people focus on is the qualifying investment. So again, non-qualifying investments can't exceed more than 20% of the total capital commitments. And a qualifying investment is an equity investment in an operating company where the securities or the investment is originally issued by the company itself. Buying shares from existing stockholders is a non-qualifying investment. Buying a position in crypto, because it's not an operating company, is a non-qualifying investment. Making a debt investment is a non-qualifying investment. So, and again, this is something where you have to apply this analysis to every single fund or SPV that the advisor manages.
And then for obligations for a manager when they do have to register, so one of the advantages of being VC exempt manager, not required to have your funds audited. And then also there's lots of obligations for sort of record keeping and documentation. Those are two of the sort of sections that I think of that managers are not excited to dive in on when they register an RIA. Is there anything else that they weigh heavily in?
Yeah, I mean, I think you have to hire a CCO or appoint someone as a CCO, a chief compliance officer. You're subject to periodic exam, by the SEC. And I think there's, without getting too in the weeds, I mean, I think there's just a more stringent sort of regulatory overlay that you have to follow. There's more policies and procedures you need to have in place. There's, you're subject to more stringent rules that dictate how you market your funds and portray track record. Now, a lot of these things, even if you're exempt, you might be following them as sort of quote unquote best practices, but there are a number of rules that apply to registered investment advisors that don't apply to exempt reporting advisors, which is what your status is if you're relying on one of these exemptions. But you're still filing an ADV, but it's a much shorter version of the ADV than a registered investment advisor. So you're on the SEC's radar screen, but there's no periodic examinations or things like that. So there's less scrutiny that the SEC has over you if you're exempt.
So let's do a little bit of a, not rapid fire, but can be sort of more brief answers, keeping to almost the venture capital specific realm. Talk a little bit about an LPAC, so a limited partner advisory committee. How common do you see those in venture capital firms? Are there thresholds where they come into play? And what's sort of the trade-offs of having an LPAC and the pros and cons?
Yeah. I think if well structured, and which I think they're very useful, and I would always recommend having them. When I say well structured, I think the point of an LPAC is that, without an LPAC, if you needed to go get consent or if there's certain things in your LPA that says that, the manager isn't going to do X, Y, or Z without, either full stop or without the consent of a majority of the LPs or whatever, having an LPAC provides a more select body or a smaller body of investors that are ideally representative of your LPs at large that you can go to. So, you might, if you have an LPAC, it's useful to be able to write into the agreements that you won't do those X, Y, or Z things without the consent of the LPAC or a majority of interest of the LPs. And so, but that's only useful if the number of investors that have seats on the LPAC is a small select group of investors. So whether it's 3, whether it's 5, whether it's 7, ideally the smaller the better. And again, it's nice to be able to have that group representative of your LPs at large. But sometimes the manager might sort of view that getting an LPAC seat as sort of a carrot and hand out too many seats, if you will. And so then it becomes, okay, well, we have 9 people on the LPAC. Is this really helpful? So yeah, I mean, I think they can be very helpful, again, if appropriately structured. And so yeah, so having outs in things that in the LPA that might otherwise you not be able to do is a helpful thing. They're also really helpful. There's a host of as the fund operates or sees different investment opportunities, and maybe it has multiple funds that it's managing. Inevitably, conflict scenarios are going to arise. If an advisor or comes to us and says, hey, what do we do here? Even if it's, kind of on the edge, or you might say, oh, there's a pretty good position, you can do this. If there's conflicts involved, it's always a good idea to be safe and run it by your LPAC. You're showing that you've spotted the issue, you've gone to the LPAC to explain the scenario with them, and they approved this particular thing you wanted to do or whatever. It's a helpful sort of prophylactic measure that you can take to kind of, I wouldn't say cleanse you might be cleansing the conflict, but at least, getting the thoughts of the LPAC and approval, where conflict is involved is very helpful.
Can I ask you to give an example? And they could be sort of broad hypotheticals or specific examples from your past, maybe 1 or 2 examples of what are sort of amendments or things that are consent you might have to go to the LPAC for. What are some of those things that would lead you to ask the
Yeah,
LPAC
I mean,
for
okay,
permission?
one example is the fund, it typically is making investments, in companies in this particular space, of technology or whatever it is. There might be there might be another opportunity that one of the GPs has. Their brother is starting a company that's in that arguably a similar space, or in the tech space, but it's not necessarily in the same sort of space as your fund is typically investing in. So the LPA will give rules about what when the GP can make investments on its own, and typically that's a no-no, especially if it overlaps with what the fund is doing. But again, if there's a reason why, maybe it's their brother, or if it's an area that the fund just wouldn't invest in, if it's a close call at all, then that's the kind of thing you'd want to go get the LPAC to bless. Other things, it's common to have investment restrictions in your LPA. The fund won't invest more than X% in a particular company or outside the US. And a lot of times those will be written with an out that unless you go get the consent of the LPAC, or, so there's lots of those kinds of things that you can do X, Y, or Z if you get the consent of the LPAC, but generally you can't.
Got it. And another VC term or question for waterfalls. So distribution waterfalls, when a fund values, the assets of a fund are liquidating, it's time to actually eventually make distributions or returns. There's 2 ways that funds are typically structured. There's a distribution waterfall, it's called an American, and one called a European. Generally, the European is considered more conservative, broadly more common, except in certain types of strategies. So I'm curious to see from your perspective what you see more common, exceptions. Just broadly, again, framing it up for the listeners, European waterfalls generally will assume that investors commit an amount of money and there's going to be a distributions, and there's maybe an 80-20 split of the profits to the investors and the GP. Typically, that split doesn't happen until the entire amount of the fund has been returned. So there's a hurdle on sort of, if it's a $100 million fund, that line's $100 million. An American waterfall is actually a waterfall like that at each individual investment. investment. And so if one investment gets invested $10 million, the threshold for that is $10 million on the capital that's liquidated for that investment. It can lead to sort of downstream effects, both positive and negative. Most commonly discussed negative is if a really early investment crushes it and returns capital to the investors and the GPs, but the rest of the fund falls short. There could be needs for clawback. So I'll pause there. Those are just a couple of the like very basic table settings. I'm curious what you see most commonly and what you recommend for different VC strategies and managers that you see.
Yeah. I mean, I think I would see American waterfalls more commonly 10 years ago or so. I mean, and you certainly still see it, especially with respect to managers that just may have a lot of bargaining power, or they're hot funds. But yeah, I think overwhelmingly, especially emerging managers, or even hot funds will employ the European waterfall, which, if you have $100 million fund, the European waterfall, and let's say you've called 40% of it, so you've called 40 million. All that's really required typically is that you return called capital, and then and so in that scenario, 40 million, and then you can distribute carry. So that's definitely, I would say, more common, and it's not impossible to end up in a clawback, but it significantly diminishes the likelihood. I mean, you still could end up in a clawback if you return the 40 million that you've called, distribute some carry, and then maybe you call more. It's still possible, because at the end of the day, at the end of the life of the fund, if the GPs receive more than 20% of total profits, there's going to be a clawback that's implicated. And so, yeah, I mean, the American waterfall is less common, I see these days. If I'm advising a fund, that is, either an emerging manager, or maybe they have an American waterfall, or sorry, a European waterfall, but they say, hey, can we switch this to American? Just sure, you can try, but investors are going to push back likely. And if you're an emerging manager that's just creating, I mean, it's better. I would always advise to do something that's sort of simple, and that's not going to be causing sort of friction. It's pretty common these days. I mean, I think if it were the case that a lot of other funds, a ton of other funds had American waterfalls, and you were saddled with a European one where you had to wait to get carry, it could be that you might have trouble hiring, hot sort of investors from other funds, where in the other funds they're likely to get carry earlier, and in your fund they have to wait more. But that's not the dynamic. I mean, the dynamic is even funds that have American waterfalls, I think sometimes will distribute more conservatively to avoid a clawback scenario, because those scenarios are very painful.
That makes sense. Well, we're getting towards the end here. What's something that you might want folks to know that they might not think about when they're engaging with a law firm like yours? They're launching a new fund, or they're thinking about hiring lawyers for a new fund launch. What's something else that maybe something they have a misconception? People often have a misconception about working with fund attorneys that you'd like folks to think of.
Yeah, I mean, I think I would always advise engage with the lawyers early. There's certain things that you can trip up as part of once you've started launching your fund. Typically the lawyers will tell you, here's the pitfalls, here's how the process typically goes. There's securities rules that can be implicated as you're marketing a fund. You generally want to avoid, talking to the public or the press. There are ways you can do that if you make sure you run your offering in a particular way. But generally speaking, unless you're doing that and following those rules, you kind of want to avoid that. So you're not going to know any of that, unless you sort of engage the lawyers early. And I would say it's important to hire folks that see the market, that see a lot of these kinds of transactions. And there are a lot of service providers out there that I think that compete, largely on price, but sometimes that not always, certainly, but that can mean that they're maybe not as sophisticated, or they don't see as much. We haven't talked about management fee waivers, but that's an example of, it's easy to explain, but there's certainly rules as to how those things work, and trade-offs as to whether to use them. And sometimes some of those details are not understood or shared from advisors that are not as sophisticated as others.
Perfect. Let's two more things. I did skip over management waivers. I scrolled right past it and I wanted to ask you about it. So let's talk about management waivers and we'll wrap up with more general advice. Been giving a lot of for sort of emerging managers, but maybe we'll sit to the other side speaking to folks, whether it's students, law students, or folks earlier in their career, sort of on your career trajectory. Let's go really quickly back to management fee waivers. Can you give a quick overview? What is a management fee waiver? How are they generally structured? And again, like trade-offs of using them.
Yeah, a management fee waiver is essentially taking management fees that would otherwise be paid by the fund to the manager and um, and essentially offsetting them by a certain amount and getting credit for the offset amount in terms of the general partner's obligation to contribute capital to the fund. Maybe taking a step back, it's typical for the general partner to contribute. The LPs want to see the general partner have skin in the game. So typically they'll put in or commit to put in, at least 1%, oftentimes more, of the total capital of the fund. And so the general partner has its own capital contribution obligation to the fund. So if you have a $100 million fund and the general partner puts, is putting in 1%, they have to put in $1 million. But these people, the fund manager may not have a lot of liquidity, and so they might need some help doing that, especially if the commitment is larger than 1%. And so this technique allows you to waive a certain amount of fees and get credit for that waived fee amount in terms of putting capital into the fund. The way the arrangement works is if you've done that, let's say you waive 50% of your or an amount of fees equal to 50% of your $1 million commitment. So you're waiving fees equal to 500,000 over some period of time. Then you're getting credit for having put in $500,000 of that million of fees, and so your cash outlay is actually just the delta, which is itself 500,000. And so but what you get in exchange for that is you get a priority allocation of capital gains, additional capital gains. So effectively, instead of getting 500,000 of fees and being taxed at ordinary income rates, you get you waive that and you get a priority allocation of additional capital gains equal to 500,000, the waive fee amount. And that's taxed, assuming you've held the securities that are giving rise to the capital gains for more than 3 years. That's taxed at long-term capital gains rate. So the technique is effectively converting ordinary income into capital gains at the end of the day. And so the benefit is both a timing benefit because you're being taxed later. You're not being taxed until you get that capital gain, but also a rate differential between whatever the differential is between capital gains and ordinary income. The downside is that in order for the IRS to respect that, there has to be risk. The manager has to be taking risk on that ultimate allocation of capital gain. Typically, that means that if the fund hasn't, at the end of the day, resulted in some profits, it's not returning capital and $1 at least of profit, then the entire benefit of that, of that waive fee amount is actually lost. And so you're so there is a fair bit of risk you have to put into the arrangement for it to be respected. And generally, I think my advice is, the higher risk associated with the investment. In other words, if you're really early, you're presumably more risky than if you're making private equity investments in real companies. And so you just have to think hard about whether that bargain, if what you're really after is the rate differential and timing, is that, we'll call it, 30 cents on the dollar, is that worth putting 100 cents on the dollar at risk? And again, I think that if you're thinking about that from a risk standpoint, I think the riskier your investments are, presumably the less appealing that is.
That's great. Thanks for explaining that. Well, this has been fantastic. What's a piece of advice now shifting to the service provider world, your world, working at maybe a law firm or just generally in ops, supporting investment fund managers, venture capital specifically? What's some advice that you might have for folks who are earlier in their career or even at school that want to sort of build a career in the funds world?
Yeah, I would say, I guess the assumption is someone's going to law school and they're interested in sort of transactional work generally. I think I would give, these are, you mentioned my tax background. I was a tax lawyer and still am to some degree in the fund space. But having a tax background, or at least some knowledge of how tax, in particular partnership tax, works, taking a class just to sensitize yourself to the issues, I think is critical, or it's very helpful. I mean, I certainly know people that don't have that, and they rely more on interfacing with the tax lawyers. But I think, unless you have a really strong sense of the economics, having a tax background can help with that. Um, I think you're not really getting the full picture. So, I think it really helps to have take some tax classes, some securities classes. I think this is a practice where, if you there's a lot of drafting involved. Even with AI, you have to know how to draft complex provisions, and it's I don't think any practice is particularly cookie cutter, and we certainly rely a lot on forms, but a lot of times you have to be creative, and drafting can help. You're negotiating a lot, so you're interfacing with other lawyers quite a bit. So for me, it's a great balance of technical and drafting, and you certainly get exposed to a lot of different areas of the law. I mean, every investor, I mentioned earlier on, a lot of investors are subject to their own regulations. You have to kind of get a sense of what those are to be able to navigate them. So you're not necessarily an expert in everything, but you get exposed to a lot, and you have to be a pretty good quarterback and bringing specialists into the fold when you need to. It's a great practice. Yeah, it's I think more of a niche practice than just being a general corporate lawyer, but it's rewarding, and it's a lot of fun.
Well, great. Well, thanks a ton for coming on. I'll have to have you on it to do a sort of deeper dive into a lot of this, but I appreciate you coming on, and we'll have to do it.
Sounds great. Thanks for having me again.
Absolutely.